Good morning, everyone, and welcome back to Morning Markets, where the team at True Potential discuss some of the key events over the past 24 hours in asset markets. Looking back at yesterday, it's pretty much more of the same, and we probably sound a little bit like a broken record over the past few days discussing what's happening in asset markets. So I'm going to take a step back today and just reflect a little bit on what we've been hearing. So over the course of the week, the key factor that is driving asset markets, currencies, bonds, equities is really sentiment. And that sentiment is being influenced by both the news flow that we're seeing, particularly as it relates to the stimulus package in the US, and also just economic data points that we're seeing. The upshot of all of that being that volatility is higher. We're seeing larger positive and negative moves in asset prices and equities and in bonds, where bonds appear to, particularly sovereign bonds, appear to have woken from some of their slumber of the past few months where yields have been relatively constrained, and we've seen yields move higher for sovereign bonds, both in the US and in the UK. Yesterday, the back and forth around the US stimulus package continued. We heard from Nancy Pelosi on the Democratic side saying that the proposals from the Trump administration to support certain areas of the economy, such as airlines, some other areas, hospitality, with specific packages, just wasn't acceptable. And that they would be looking for a package that was much broader in its terms and offered support across the gamut of sectors that required it, and also individuals. So, large gap there. They progressed again. We continue to hear more from President Trump. He's coming round to the side of, well, maybe a large stimulus package could be now agreed before the election, which, going back a few days, just reverses what was tweeted earlier in the week. So that's the push and pull that's really impacting markets. How did that play out yesterday? We saw equity markets continue to move higher on that positive side, so more stimulus could be coming. I think that was neatly summed up by one of the Fed governors who spoke yesterday, and effectively laying out the case very, very succinctly for why fiscal support is important. Basically, what his analysis is, and is correct, is that the Fed, they can support and improve financial conditions. What they can't do is replace lost income. That's why fiscal support from their perspective is really important at this time. So that will continue to impact sentiment, I have no doubt. We'll continue to hear the push and pull of that news flow over the coming weeks. What it does mean is that we're likely to continue to be with this higher level of volatility in asset prices, and that will continue to work its way through until we get to the 3rd of November and the outcome there. The other aspect of that is that you want to remain well diversified in that scenario. The impact is different in different asset classes, in equity markets, bond markets, currencies, etc. So thinking about diversification in a portfolio context is crucial with that as a backdrop. I think the other thing I just wanted to touch on today was some of the information that we heard from the ECB yesterday. So we got the minutes from their meeting of last week. And what did it indicate? It provided us some detail on how they were thinking about the strength of the euro. And I know in the press conference, Christine Lagarde did play this down a little bit, but the minutes do highlight a concern on two aspects from the euro strength over the past number of months. One, that is curtailing the impact of some of the stimulus programs that the ECB has put in place. And secondly, that it's eroding the inflation impetus in the Eurozone economy. So stronger euro, you're not importing weaker, you're not importing inflation into the economy. So that's one thing that is worth bearing in mind, that euro strength is perceived within the ECB as a slight negative on the growth outlook. This morning we've had UK GDP data for the month of August, and it continues to show improvement. So it's the fourth consecutive month that we've seen improvement, albeit it's the slowest rate of improvement, so 2.1% month on month. It still leaves the UK economy in aggregate some 9 to 10% smaller than it was at the beginning of February, so prior to the impact of COVID coming through. Where we see a bit of an improvement in the economy is on the services side through the course of the month, but that's very much supported by the Eat Out to Help Out scheme. And as we know, that was only in place for the month, and that has subsequently been removed. So the challenges are evident in the GDP report that's come out this morning. It just looks at the challenges that manufacturing and industrial activity continue to face. So again, highlighting just how important fiscal support is likely to be in the coming months. That's it for today. Please do subscribe on YouTube to our morning markets, and we'll speak again next week. Thank you.
Subscribing to True Potential YouTube channel is quick and easy. Simply go to your YouTube app on your phone, type in True Potential and press the red subscribe option. You'll then be notified as and when new videos are released.